Now, what are the issues that could occur when a component is located abroad, which is outside the parent's group jurisdiction? So, if let's say there is a company which is located in a company which is the parent entity, it's located in United States and has a subsidiary which is located, that is called as B company, and let us say that is located in India. What could be the problems that could arise when you audit this group company? So this group A company, which is A plus B, what will happen? Or what could be the issues that could arise? Firstly and foremostly, if there is two jurisdictions, different accounting is the first issue that could arise. As I told you, when a company is working in its own jurisdiction, it has to follow its own jurisdiction based accounting policy. Like in India, they will follow Ind AS or India GAAP. Whereas for consolidation purposes, it has to be consolidated into US GAAP because the company's parent entity is in US. So in order for consolidation, the Indian transactions have to be converted into US transactions and posted. Are there differences? Yes, there could be a lot of differences on how they are treated. To give you an example is, the borrowing cost. In India, borrowing cost is allowed only for certain specific, transactions. But for US, you can take any borrowing cost from any of the loan and accumulate it. So there are a lot of differences. So that could actually affect the way they account these transactions. Depreciation, there are complete differences compared to US versus India. So that could be one of the problem, which is the accounting policy. So when the line by line consolidation happens, we need to ensure that the Indian company's accounting policy have been converted into US GAAP and then consolidated. So a company which is having multiple branches, technically what they will do is they will follow a local GAAP. They will follow a local GAAP, which is India GAAP. They will have two accounting. One is for Ind AS, one is for specifically for US GAAP. And both transactions are posted in such a way that, okay, either they will be posted only in India GAAP or they will be posted only in US GAAP, or they could be posted in both. So there will be three branches you need to mention. So every transaction, you need to select what type of entry you want to post. You want to post it only in India, you want to post it in US, or you want to post it in both. So those kind of complications will come, and that's have worked in such complications, and trust me, it is confusing. Sometimes what will happen is that you might forget to post it in US GAAP, but technically you had to post it. And by the end of the year, the US consolidating guy is calling us. He's saying, see, I'm seeing differences, what is the issue, etc. So those kind of situations would come in, and you have to be very skeptical about it and ensure that such controls exist such that they are mitigated. The second one is the cultural problems. Each country has its own way of dealing with things. So there could be, and the group auditor will need to be sensitive to these dealings, the component auditors. There could also be language problems. To give an example, in China, they don't speak English at all. So Chinese, they speak Chinese language only. So it's very important that a component auditor have to be in China, and he has to know if he is to be in English. The Chinese auditor have to speak to the Chinese people. There is also, like for example, in Luxembourg, Netherlands, all the local contracts are in Dutch. So it's very difficult for us. If you don't know Dutch, it's very difficult for you to read it. Like Germany, local, all are in German. All the contracts that you get for that particular entity are in German. At least in India, you have an option to write it in English, right? So for Indian audits, it's easier because we follow on regular reporting perspectives, we follow English language only. But there are countries which do not follow English language at all. And for them, reading that language, knowing that language is very difficult. Middle East, they follow Arabic. So certain contracts will be completely in Arabic, and you need someone to read that particular Arabic language. There may be existence which are specific to the country in which the component operates. For example, some countries are subject to hyperinflation. Accounts produced in these circumstances will need to be adjusted prior to consolidation with the present. If the component is located in a developing country, there may be aspects of business infrastructure missing. Example, education, technology, even anti-bribery legislation. Factors such as these will need to be identified for each of the component and tackled according to the appropriate during the audit. So when it comes to audit risk, it's not just about accounting related issues, not just about control related issues. There is also about regulatory issues as well. Like a company might be doing certain adjustments, and those adjustments, because the company is having an hyperinflation, so their adjustments need to be taken into consideration. There could be certain regulatory aspects which are missing, like nobody's bothered in that particular country, like there is no specific regulation like in the group parent entity. So what happens is that they can post whatever they want, so they will post whatever they can, which will lead to problems like whether there are misstatements, and those specific unregulated entities will have to be very clearly reviewed, because they could contain misstatements, they could contain reporting issues which should not be done by the parent entity in their regulated operations. So those kind of issues could arise. And one of the main important aspect which they have not mentioned when it comes to issues arising when the company is located abroad is foreign currency translation. My God, this is one of the most important as well as a most trickier one, because all the currency have to be translated into the parent country's reporting currency, and then only they can be consolidated. So if a company, as I told you example, if A company is in US, B company is in India, all their B companies transactions which are reported in at the year end in Indian currency have to be translated to US currency, to US dollars, for them to consolidate, because otherwise the consolidation will not work. You cannot consolidate directly from Indian currency to US currency. This is one of the biggest issue and one of the most common issue which is gonna affect, because there could be lot of troubles when you audit such foreign currency gain, translation adjustments, etc. So the next one is the correct classification of investments. You would have learned in financial reporting that an investment is treated as subsidiary when the company has control over the company. So the control will automatically, by ownership percentage, the parent entity will get if they own 50% or more. But if they own 50% or less, but more than 20%, then greater than 20%, but less than 50%, right? So if they are between 20 to 50% range, then they will have significant influence. If significant influence is there, then it's a associate. If they have control, it is a subsidiary, right? Now anything less than 20%, automatically it will be a mere investment. All right. So one thing that you need to note is you can identify this is whereby you need to consider how the investments fits into the activities of the group. So for that, you can review the board minutes for evidence of any degree of influence exercised by the parent. They should also discuss with the parent's director. So to give an example, even though the control you don't have ownership of more than 50%, sometimes the parent will have control, because they are the ones who are day-to-day working for the company, or day-to-day taking decisions for the company. So if that such situations is there or not, you can check by reviewing the board minutes. So if you review the board minutes, you will come to know whether the decisions for the subsidiary is taken by the parent or not, and are they having significant influence over the parent. That is taken by reviewing the board minutes. The existence of other significant shareholders may indicate that the parent company has little influence. So if there are other significant directors or significant shareholders, then the company might have little influence over the subsidiary. So for that, they can also check the register of members, like the shareholding percentage and potential influence held by the company. So you can review the board minutes to see if there is significant influence. You can also check the shareholding registry to determine the level of shareholding percentage, etc. The auditor should also consider how easy it is to obtain information about another company. This could also be an indicator of significant influence. So if there is A company, B company is having around 15 to 20 percentage, etc. Now, if A company gets to know all the details, information on a daily basis from B company, then it could indicate a potential significant influence. So the first case when you have a group entity is to identify what kind of investment is the second company is, whether it is are they having control, are they having significant influence, are they associate, what kind of investment it is something that they need to identify for the first time. The next one is consolidation audit process. So there are a number of procedures that should be performed by the group auditor for our consolidation of the financial statements. Firstly, confirming the balances extracted from the financial statement of each component prior to their inclusion in the consolidation schedule. Firstly, you take up the component's financial statement and confirm the balances extracted are appropriate. Compare against the component auditor's report and to see if the balances extracted are appropriate and there are no changes. Review the disclosures necessary for the group accounts such as related party. Because as I told you, for consolidation, there will be a lot of intercompany transactions that will be eliminated and that have to be updated in the related party transactions. Because for the group, all the related party transactions within the group have to be reported, and as per the standard, it is very important to be reported. Gathering evidences appropriate to various consolidation adjustments. So we would have learned this financial reporting. There are intercompany transactions, investments and equities are cancelled against each other. Then there could be loans given. All those intercompany transactions, NCI calculations, all of those things, consolidated related adjustments have to be posted and have to be correctly reported in the group. And you need to gather evidences for those transactions. If it is, let's say, NCI calculation, recalculating the NCI, seeing whether taking the retained earnings, removing all the adjustments, and seeing if NCI you are able to recalculate, and then confirming that the NCI is appropriate. Investments and equity investments and then equity share capital of the subsidiary. Investments, what is the investment done by the company based on the shareholdings and etc. And see if the fair value is actually used, and then you can remove that appropriately. You can carry it at cost, that's not an issue. Then equity, the equity share capital of the subsidiary have to be checked and see if it has been removed correctly. If it is NCI is there, and then the 100% share capital is removed, and then remaining is reported into NCI with the NCI's whatever the method they are using, fair value of NCI, etc. Goodwill calculation. Goodwill is something that is calculated by when we are consolidating the balances. So we might have to recalculate the goodwill. So depending upon that, let's look at an activity. What are the major types of consolidation adjustment required for the group financial statements? Let's try to answer this particular question. So let's look at the solution. The first one is the calculation of goodwill and including any impairment review. So that's the first and biggest consolidated related adjustment that we post. So the goodwill is calculated and shown in the asset side of the group entity. That is a calculation that is involved, like we take the consideration paid minus the fair value of the net assets of the subsidiary, you get the goodwill, and if there are impairment, then goodwill impairment is calculated and shown. So that's a bigger calculation, and based on that we will recalculate the balances, and consideration paid we can verify against the bank statement that have been where they have transferred the money, and we can check against the investment subsidiary agreement. We can also check against the share certificate, etc. Fair value of net assets of the subsidiary, we can check the financial statements of the subsidiary. If there are fair value adjustments, we can ask for the fair value balances and check what are the fair value changes, etc. So the first one is the calculation of goodwill, including any impairment reviews etc. Right? The second one is cancellation of intra-group transactions and balances. So cancellation of intra-group transactions and balances. Example are dividends, intra-group loan, etc. The third one is unrealized profit, provisions for unrealized profit resulting from intra-group transactions. So provisions of unrealized profit, I am writing it as URP, unrealized profit resulting from intra-group transactions. So any unrealized profit that we generate based on the subsidiary and parent selling, that will have to be adjusted. When we calculate goodwill, there will be subsidiaries fair assets and liabilities fair value have to be taken. So during the time of consolidation, then there will be fair value adjustments on assets and liabilities. We need to calculate that. So fair value adjustments of assets and liabilities. So that have to be calculated because what happens is that there could be specific assets or liabilities which are taken into consideration only at the time of consolidation. Give you an example is fair value of contingent liabilities or contingent assets. There could be certain brand you are acquiring, certain customer brand that you're acquiring, intangible assets that you're acquiring, which are used only for at the time of consolidation. So those fair value adjustment, and when we are auditing it, we have to look at review the fair value adjustments taken, how they have calculated the number, on what basis they have arrived at this calculation, what are the evidences with respect to these fair value adjustments, and whether the fair value adjustments have been calculated properly, what is the basis, what is the management assumption relating to fair value adjustments, recalculate the fair value adjustments, etc. What are the movement on fair value adjustments like depreciation if there is any, etc. All those things we need to take into consideration. The fifth one is retranslation of financial statements for overseas components. So overseas components are there, then there will be translation adjustments as well. So retranslation of financial statements of overseas components. Then the correct value of any components included in the parent company's financial statement. So the correct value of any components which are included as part of in the parent company's financial statements. Parent company's financial statement. What is the correct value of any components which are included in the parent company's financial statement? So how they have reported the components investment in their financial statement. So these are the few consolidation adjustments which could affect the balances.